Welcome to Facts Pro, where it's all about facts, financial, accounting, and tax strategies. Today, we continue with the series talking about the advanced tax strategies. And the reason for that, we started this last week, is because I get a lot of, okay, I've learned a lot about tax planning, I've done a lot of strategies as far as like entity structuring, hiring children, Augusta rule, rental, real estate, and short-term rental loophole, and all of that. I've exhausted these strategies. Is there anything more that I can do? And the answer is always yes. There is a ton of strategies out there that are still available for W-2 doctors, for business owners, for everyone that are on the like high earner, like on the high end of the revenue or income, and they want to reduce their taxable income by a good amount because they're having the pain of paying too much taxes. So today we want to explore another advanced tax strategy, and let's dig in. I'm gonna share my screen, and as you know, I always like to start with a joke, and the joke today is about related to the oil and gas. It's from the great workers in the oil field. It says, "You think putting me on hold will get rid of me? The oil field gave me a particular set of skill, which is I can wait for hours for no particular reason." It's like, of course, yeah, I don't have to explain the joke, but you get it. All right, so what are we doing? Oil and gas investment, we're turning taxes into wealth. So how high income earners can use energy investment as a tax strategy, and particularly we're talking about tax oil and gas investments. All right, so why oil and gas? Why am I talking about oil and gas? Because for all my clients who are high income earners, they face high tax burdens. You have a high tax burden, you have a high tax liability, and there are some certain investments available out there that can offer unique tax advantage. And oil and gas is one of those biggest tax advantage opportunities that are available to you. And we're going to learn why. As we said before, taxes is your biggest expense because for many physicians, taxes take about 40 to 50% of income based on what state you are and based on the highest tax bracket and all of that. So you need a strategic planning, and strategic investment can flip this around for you, so it would reduce your tax bill, and it maybe move you from a high tax bracket to a lower one. All right. So how does the oil and gas work? The special tax treatment for oil and gas that's making it very tax advantageous is, first of all, the intangible drilling cost. You get an immediate deduction. So you can write off a big chunk in year one, like about 80% of your investment, you get to immediately deduct, especially now with the bonus depreciation that it went back to be retroactive. You get to deduct 100% depreciation on your tax return. So intangible drilling costs, you get immediate deduction on that, which is about 80% of your investment. For the tangible drilling cost, the other 20%, you get it depreciated over 6, 7 years. So it provides you again with the big write-off year one, and it continues with you for a couple more years. In addition, there is a depletion allowance. So this is the ongoing tax shelter for the income you generate from the investment. Because I'm not here to talk only about tax savings, I'm also talking about wealth building. So we're talking about some investment that will generate you income and will generate you profit, that 15% of it can be tax-free every year. So it's definitely not only for year one that you can take a deduction, but even ongoing investment or ongoing revenue, you get to have 15% of that tax free. All right. So how it works. So talking numbers, if you invest 100,000 in a drilling program, like in an oil and gas investment, You get 80% deduction in year one. Of course, this number is like it's up to 80%. And or about it could be even more. It could be 88%. So it depends on the investment. You get, let's say in this example, we say 80% deduction in year one, which reduce your taxable income. The remaining 20% depreciate over time, as we said, over 6, maybe or 7 years. In addition, the potential cash flow from the production is taxed favorably because it's not 100% taxed. You get some energy saving on that. And as we said, this is not just a tax play. We're not just doing something to avoid taxes and we're wasting this money, not getting it back. We're talking about investing in an energy production that can generate you a profit, or it can make sense from from an investment perspective to get your return on your investment. Um, it could be traded as a passive or a non-passive, depends on the deal, depends on what exactly the investment that you're getting into. For general partners or for some investment that would require active participation, this can reduce your deduction. You can use the deduction to reduce your W-2 income, your active income. But if it's a non-passive, if it's this is considered non-passive, but if it's a passive investor, you're a limited partner, then you get to use the deduction to offset your passive income only. So when you come for tax planning, that's what we integrate into the tax plan. What do you have? Do you have passive income that you want to some passive losses to offset, or you're mainly worried about your W-2 income and you need some sort of non-passive losses that offset that? And are you able to meet the requirements? So we have to think strategically to see which one you would qualify under and which one it would work good for you. But again, for most people, you can do it both. Like, I mean, for a lot of investments out there, there are both options available based on what you choose. And with doctors, you often qualify through structured partnership. And of course, the structure matters because you need to structure this strategically so that you get the most tax benefit. There are risks, definitely there are risks. There is actually a high risk because oil and gas, you get like there is market volatility, there is operating costs, drilling doesn't always produce. So there is a risk, but with high risk comes high return. So there is potentially high reward, not only in tax savings, but also in the production income and in the like the return you will get on your investment. It's best for the accredited investors with high income. It's not something for everyone. And same thing as I said last time with Bitcoin mining, it's not for everyone. It's powerful for the right situation and the right strategy. How to explore this strategy? First of all, you need to evaluate suitability, and that's what we do when we do a tax planning. We look at the income level. What are your goals? What is your risk tolerance? Like if you're really conservative, I wouldn't recommend something like that for you. You need to work with a reputable oil and gas operator to some sort like not guarantee, there is nothing guarantee at all, but to see their performance over the past and to see if they're good enough to operate with them and generate some profit. And definitely to align with your tax professional to maximize the deduction and integrate that into a broader financial plan based on your goals, because you want to diversify your portfolio, diversify your investments, and see which of these can generate you the best savings and the best wealth building tools. So again, just to summarize, the government rewards the investors who take risk in energy production. So why not use that to your advantage? And if you're a high income earner and you want to explore if this works for you, then let's talk. And here's my information if you want to talk about it to see if you can incorporate it and integrate it into your tax plan. If it's something that can work for you, 2025 is not late to do that. There are some investments available that you can explore if if you think that you're gonna end up paying too much taxes in 2025. All right, thank you so much. I hope you have found this helpful, and I'll see you next week with another tax strategy. Take care.